now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. Today we're back with Justin Huhn of the Uranium Insider. How you doing?
Doing very well, Daryl. Good to see you again.
Hey, you too, you too. So is the uranium trade dead? We got some. I was wondering if you got any hate mail or anything. The equities took a big nosedive, I would say, and then it's a good buying opportunity. If you weren't in the uranium trade before, it's a good buying opportunity. If you were, you may have lost a shirt or two. But just wondering, what's your outlook there?
My outlook is very, very positive. Um, Focused on this sector for the past 6 years plus, and looking at what is laid out in front of me, it's astonishing that these equities are trading where they are. It's been a very difficult last few months and especially last few weeks. There's no hiding it. The equities have performed extremely poorly. There's multiple reasons for that. One of them, obviously, is the slippage in the spot price of uranium that we've seen over the past year, roughly. And we had a period of stability in the fall where it was stuck around, 75, 80-ish, but it's pulled back down. It's now, I think, 63, 64 as I'm seeing it today. It doesn't look like any trades got done at that price level, but that's where the market is trading. But we've also had a couple of periods where, these equities can get lumped into cross currents in the markets. So oftentimes you'll have funds build what you would call a factor basket, where you have multiple different themes kind of pulled together in order to have some kind of exposure to a broader theme. So this AI story, uranium, and some of the nuclear names as well have been lumped into these AI quote unquote factor baskets. And when the bloom comes off the rose for AI for whatever reason, oftentimes you see uranium equities get dumped. And is that fair for that to happen? Not necessarily, but this is a very, very small market. And then you just have what's literally momentum. The spot price is kind of slipping. Not a lot happening in the physical market. AI stocks are coming off. The selling pressure is there. The shorts start to pile in. Then you have stop losses get hit. You've got margin calls and and you just snowballs, right? And it happens over and over. It's happened many, many, many times since I've been following this market. With all of that said, the equities performance has definitely been disappointing from somebody who's been long for years now. I've done a bit of trading over those years. So, that performance can be buffered a bit, but looking at the screen and seeing where these are at relative to the fundamental story, it is both painful and extremely exciting from a contrarian speculator's point of view. So what we've seen in the past, let's say 3 to 4 weeks, is we've seen a lot of frustration expressed publicly from retail investors, on platforms like X, right? And that just continues to happen. While at the same time, you've seen people like our last webinar, our members webinar guest, Larry McDonald. You have the Rick Rules, the Kevin Bambros of the world. They are all absolutely salivating because they have a constructive view going forward for the nuclear energy sector and therefore the price of uranium. And when you have a 50% off sale, that's when you put some money to work. So myself personally, the people that I am connected with in this industry, the quote unquote, the specialty funds that are focused on this sector, the smart money that actually has done work. So this is not institutions that they get the story. Okay, AI, oh great growth. Okay, nuclear growth. All right, this is cool. We'll put a little money in Cameco and URA. It's not them. It's the funds that are actually doing thousands and thousands of hours of work modeling out this sector. Those guys have gotten leveraged along with some aggressiveness in the past weeks. So it's just, some things never change. You have capitulation and terrible market sentiment. And the other side of that trade is, for every seller, there's a buyer. So these shares that are being thrown out, like yesterday's garbage, somebody is buying those shares. I'm one of those somebodies. But a lot of speculators that are still very constructive on this sector going forward are getting longer here, looking at the terrible sentiment and the price action. So it's just how it is in the market. Sometimes you have to deal with what the market gives you, and the market has been dishing out blood. And so for speculators that are constructive, it's a gift from the heavens. For everybody else that's, has all of their capital invested and they've been riding this thing down, it's been a frustrating ride.
Yeah, yeah, yeah. I mean, I've been buying. I'm just I don't know how much lower this could go, but just seeing the prices, I haven't seen some of these prices in the last 3 to 4 years since I've gotten into the trade, and so with some of the companies that I'm buying. I mean, Denison, we talked about Denison before. I mean, hitting what, $1.30 or whatnot. When I started buying Denison, it was at about 90 cents to $1. And so, just being able to see like, oh, wow, like, yeah, these are significantly lower than the last, where they've been in the past few years. So I've definitely been putting some capital to work as well. So I do want to bring up a couple of charts and kind of get your perspective
Sure.
on the supply and demand. So we have Yellow Cake and Sprott, which engages in the spot market and their projections on where supply and demand is. I've brought this chart up on a couple of interviews. This one here is Yellow Cake. They have their demand levels is lower than 200 million pounds. When you look at this line, and they're saying that the supply in the market will exceed demand for a number of years, and then this is the base case, and then this is the high, and so they're saying that it's not really going to fall off where supply doesn't equalize with demand. The base case for demand, their base case, until 2032. Now their base case is a lot different than. Okay, so now when we look at Spud, this is their uranium supply and demand estimates. So they're saying that the demand is at about 200 million pounds, and the supply is going to be exceeding demand in the next few years, and then you begin to see that start to decouple in 2029, 2030 versus Yellow Cake in 2032. And so obviously this is a different part of the market when you're looking at the spot market and secondary supply or whatnot. But just wanted to get your take on these estimates. I mean, they have a discrepancy between both of their estimates for their base case for how many pounds, millions of pounds are going to be needed. But then they both kind of point to mine supply being able to cover the demand over the next 3 to 4 years.
Right. So you want to keep this one up? You want to pull up the Yellow Cake graphic again? I can speak to
Yeah.
both.
Okay. Yeah. I'll pull up the Yellow Cake, and then we'll go here.
Sure.
All right. Here we go. Yellow Cake.
Nice. So I can't yet share our own modeling graphics yet. This is something that we shared earlier this month with our membership, and this is after thousands of hours spent researching the sector. So basically taking the entire operating universe of the global nuclear fleet, you have to make a certain base case assumption about tails assay for enrichment, and that is a blend between operational and transactional tails. And that you can actually go to Uranco's website, to their SWU calculator, and you can do a calculation based on that tails assumption to kick out a number, right? So, but basically, roughly what we're looking at in terms of demand, and this is in line with UXC and Trade Tech, and these are the two main nuclear fuel analysts that have been operating for decades. This is in line with their numbers as well, right? So you can see this, the source of this graphic is an entity called MindSpans, which I'm not familiar with. But UXC, Trade Tech, our own modeling of colleagues in the industry is basically a gigawatt operational capacity is roughly 475,000 pounds of uranium demand per year. Now, when you're looking at new reactors connecting to the grid, you basically can triple that number. You have a 3x annual demand going into the initial core load for a new reactor connecting to the grid. And while it's a tricky, Daryl, because when you model this out, you inherently just have to kind of put your foot down and say, we need to take a structural snapshot of demand and supply on an annual basis and model that out reasonably into the future. While at the same time, the demand is actually pretty flexible based on inventories, based on the dynamics in the market, based on price, based on availability, whether or not there are motivated sellers, et cetera, et cetera, et cetera. So while you plug in for demand in any particular year, for example, initial core loads for 25, 26, 27, it's highly likely that the initial core load for a reactor that's supposed to come online next year, they've already got that fuel sitting at that facility. So it doesn't really mean actual demand of that year, but you have to model it in that way because there's just way too many complexities to get into exactly what is going to be purchased on an annual basis versus what is being supplied. So with all of that said, just looking at this graphic and looking at their numbers, they have their demand base case for 2025. That looks like it's probably in the ballpark of 165 million pounds of uranium. That's about 35 to 40 million pounds short, not including secondary demand of what our and our industry colleagues are actually modeling for. So I don't know what their assumptions are, and you have to know what their assumptions are to really gauge what the heck is going on here. So looking at that, their demand is low. If you look at their high case, even that is below industry benchmarks. So I don't know what their calculations are, but I can tell you that they are not in line with our own and all of the other people that we are in communication with in the industry. So I'm not saying one is right and one is wrong, but I'm saying this stands out as being tens of millions of pounds of demand lower than even the conservative industry analysts like UXC.
Got it.
You
Really quick,
also,
really quick.
yeah,
So this kind of it's a way to help me understand this, but
sure.
this is similar to like when people do stock valuations, like or they project out this is the future cash flow, this is the future how much money the company's going to be making and such, and people can have different numbers on that. But you may have some folks that got similar kind of projections out, and then some folks that are like way different. So this would be like one of those, uh, someone that does some stock valuations, and they're coming up with way too conservative or low, or have a low outlook on where the company's going to be in a while. I mean, it's just kind of like a analogy that makes sense to me. Is that kind of in line here, like where
100%. I think that's a great analogy. Absolutely. And the other thing in line with that analogy is even though you might have different valuation assumptions for a particular company, and let's say all of them look rosy for the future. I mean, we can take, for example, like the offshore sector. If you want to do a forward cash flow analysis for Noble or Valaris, it's like, okay, looking years down the road, they're going to be printing cash. Stocks are off 60%. It doesn't necessarily translate to what is happening in the physical market, right? So these supply and demand forecasts, they're absolutely crucial for any commodity investment. You have to understand what is the future picture for this, but it doesn't necessarily mean that any given week or month or quarter or even year is going to reflect what these models are dictating. So another example, if you were to go back and look at supply and demand models going back in 04, 05, 06, 07, we had effectively a balanced market. And what you had at that time, you had 20 million pounds of secondary supply from megatons and megawatts annually. In addition to underfeeding secondary supply, you had an enormous amount of supply. You had a balanced market, but you did have the story of rapid Chinese growth. And then you had a couple of disruptions. And all you had is a recovering market moving back into the range of what was needed for the industry to produce uranium. And then you had a couple things like the Cigar Lake flood, and you had hedge funds speculating, and you went from arguably incentive price in the 60s, 70s back then, and it doubled in price based on speculation and a couple of exogenous events. So when you look at the broader picture, and even this graphic, which to me seems like their demand pictures are utterly incorrect, you go out into the 2030s and you have a problem. And if you look at the green parts of those bars, the green parts are probable projects. What is a probable project? It's a greenfield project that hasn't started development yet. What are probable greenfield projects? It's filling that. What is that? Close to 10 million pounds, 8 to 10 million pounds, 2025. What is that, 2025? I don't even know what that is. Okay. And you got to 2026, you're looking at 15 million pounds in greenfield supply. All right. Well, 2026, maybe we've got DASA. What else? I don't even know. I don't even know what those greenfield projects are that they're modeling into this. But you go out a few more years and you're looking at 28, 29. I'm presuming they're assuming that Phoenix and Arrow are part of that bar, which then you're looking at, I mean, it's hard to gauge this because they don't have horizontal lines across those demand numbers, but that's probably 35 million pounds in that green segment for 28, 29, somewhere in that ballpark. Well, and this is from March of 24. Okay, so why is Yellow Cake using a supply and demand model from a year ago in the most recent presentation? I don't know, but that seems like that should be updated. Why? Just last week, we heard that the CNSC, the Canadian regulatory body, is requiring 2 hearings for NexGen's Arrow project, one in the coming months and the following one in February of 2026. And these hearings are mandatory before they can even consider issuing permits or not. Now, they're likely to be issued those permits. They have local support. They've done all their homework, right? But it's another year before we have the final hearing and then the issuing of permits. So even going by NexGen's, what the whole industry believes is optimistic timeframes of 42 months of construction that will begin the following day after their permits are issued. Mid-26 permits, 3.5 years of development puts ramp up production for Arrow at 2030. So this chart, this graphic is already outdated for that. And that is if everything goes perfectly smoothly, on time, on budget, which has never happened for a uranium mine. This is not me trying to talk my book and saying, yeah, mining is hard. Yeah, this project and that project are going to be fraught with problems. I'm not picking on this company or that project at all individually. What I'm saying is this hasn't happened before, where a uranium project just doesn't hit any speed bumps. So best case scenario, we've got Arrow ramp up in 2030, and odds are that is not going to happen. And this is a really, really, really important point, because this is basically, this is the linchpin project for the supply story. Utilities almost universally believe, up until last week, and we still have not had an official statement from the company kind of revising that timeline, but up until last week, the previous guidelines for this projected time frame for development of Arrow was first production in 28. And they signed 5 million pounds of contracts with delivery starting in 29. There's flexibility there, I'm sure, so it's not a big deal for the company, but the whole industry thinks that we're going to have 29 million pounds coming out of Arrow in 2028. That isn't going to happen. That straight up is not going to happen, period. And all of these graphics need to be revised to reflect that. So these things are constant work, okay? I am in our model on a weekly basis, changing the numbers with the news flow that comes in. And it's an exhaustive exercise. It's important to do. It's important to grasp the future general outlook. But there's dynamics in the market that affect what's happening right now that have nothing to do with the supply and demand dynamic, right? We've got a price trend going down in spot. We've got a stagnant term price here. We've got a new administration in the largest market in the world that is, at the very least, confusing people with the tariffs, no tariffs talk. Are there going to be tariffs on material from Canada or elsewhere? That affects a utility's decision on contracting. Is there going to be some version of the investment tax credits that were in the IRA? Will that be continued in some other form or not? Will there be other nuclear supportive elements coming out of the Trump admin in the coming months? Yes, there will be. What that looks like and exactly when that happens, I don't know. And the utilities sure as hell don't know. So they're on the sidelines there. Will we have peace in Ukraine and therefore some sort of peace deal between the US and Russia? Will that affect my deliveries of EUP in the next 3 years? All of these things are overhanging the market in a big, big way. So it doesn't matter if your supply demand graphic looks like what you just shared from Yellow Cake, or it looks like what is coming out of Tribeca. You know, Guy Keller, one of the sharpest voices in the space, who actually is going to be our members webinar guest in the coming days. They have done the work. They've read from cover to cover UxC's quarterly uranium market outlook. This digs into exact reactor demand for every reactor on the planet and expected mine supply. So, and this is the interesting thing, Daryl, too. So, I mean, this exact subject is so complex. So I apologize for going on and on about this, but the demand picture, besides the tails assumptions and the uranium demand for that tails, which is arguably the main variable, you can pretty easily go in and figure out what reactors are operating right now, what's under construction, when will that be connected to the grid, what reactors are operating now are likely to be life extended past their expected expiration date and which ones aren't. That's pretty easy for the next 5 years, 6 years, maybe even 7 years. You go out beyond that, you have to start making some assumptions because you know out of the 30 reactors under construction in China right now, most of those are going to be grid connected in the next 5 years. So is China not going to build any reactors that will be connected 2032 to 2035? Of course they are. So you have to plug that in. But besides that, the demand picture is pretty freaking clear. We know what's operating. We know what they're consuming. So to see these drastic different numbers between us and Canaccord and Tribeca and UxC and TradeTech and Cameco and TD and RBC, like all of these entities have a general model that looks pretty similar, and that have this other entity that Yellow Cake is promoting have a drastically different chart. You have to assume that their assumptions are pretty different. So there's elements in the market that affect the things in the near term, even in the midterm, but big picture, there's a severe supply problem in the next decade. There's a shortage of material right now, meaning there is insufficient supply relative to demand currently. There will be next year. There will be the year after that. And there will be until these big projects that have not even moved a rock yet are producing cake in a can. And when will that happen? You can look at the company reports and they'll tell you, you know, Denison is telling us that Phoenix will be producing in 2028 or maybe even 2027. And again, no dish on the company. I think they're doing a phenomenal job across the board on multiple fronts. But you can also go back and look at a report from Denison in 2018 that said that Phoenix would be producing uranium in 2022. And that's the truth. The can just gets kicked down the road because all of the other elements in the market, the regulatory bodies, all of these things are extraordinarily complex, and supply is very, very difficult to bring online in greenfield projects. So I'm going to wrap this up. The industry is in for shocks. That's the only way I can tell you. It's what is going to happen. That fate is already sealed. It just hasn't happened yet. And that's why moments like this, when the equities are sold off, are so exciting to me, because nothing has changed this outlook. In fact, the demand picture gets better almost by the day. And these projects can't come online on time. They physically just can't, and they won't. And anytime these projects get kicked down the road, unless we're in a moment like this where there's terrible sentiment it's going to have an accretive effect on the price of uranium. So that's kind of the base case. Greenfield delays is the base case. And with Arrow going from 2028 now to 2030, and probably 2031, 32, 33 is going to be more realistic for first cake in the can for a project like that. That has a meaningful effect on what utilities are going to expect to come into the market.
Got it, got it. So what kind of projections have you been seeing on your end? Because I know you're connected with the industry, and so some people are just, they may buy Sprott or Yellow Cake, and they attend an investor presentation, and they get these graphs, these charts, or you get like these conservative demand cases or whatnot. I mean, one is way conservative, way under than the other. I mean, Sputt's demand case was at about 200 million pounds versus the Yellow Cake was at I don't know, 165, 170, whatever. So what are you seeing like in for demand? And I mean, obviously you gave us the facts of like how this stuff works on the ground, but what are some of the charts or projections that you're seeing on your end?
Sure. I can share, let's see, I'm going to share this graphic model. This is from a recent report from Canaccord, and full attribution to Katie LaChapelle and her team in Canaccord, right? And you can see the sources of their data. Canaccord Genuity estimates, company reports, WNA, which is the World Nuclear Association, which, by the way, WNA, they put out a nuclear fuel report every 2 years. There will be an updated one this coming September. And they have basically teams that are working on these fuel reports. You have supply and demand teams, and these are made up of industry professionals that have literally spent thousands and thousands and thousands of hours of work in the nuclear industry, and they understand what they're doing. So the WNA fuel report is very highly respected. So they're using data from WNA, company reports. So this is, the actual mining company saying we are going to be developing X, Y, and Z. And this is our projected timelines. And you have to take their word for it, but you can also kind of implement your own experience and understanding of the challenges that project might be facing, right? And then, of course, Trade Tech and UXC. And those are the two large primary nuclear fuel consultants, analysts. Their customers largely are nuclear utilities, but they, of course, do their own modeling, and they're not really in the business of predicting the future. Trade Tech does that a little bit more, and they've actually been a little bit more over the target, let's say, over the last few years. UXC sort of kind of, I mean, they're projecting, like they'll tell you uncovered needs, right? So there's what, 2.1 billion pounds of uranium that needs to be contracted between now and 2040. Like those numbers are coming from UXC. That's an enormous amount of uranium that has to be contracted in the next 15 years. But their customer base is utilities, okay? So data is pulled from all of these sources, including their own work, to create this graphic, right? So you can see they've got that big, the lighter blue restarts and greenfield supply. Big one in 2030. So what is that? That's Arrow, right? So they have Arrow coming on 2030, and that was their estimation when it was still understood from the company reports that it would be 2028. So I'm sure in the coming months or later this year, Canaccord will be updating this overall fantastic research report that they put out back in January, by the way. So already you're going to have to move that big blue bar over at least a year or maybe even two. And you can see at that point, maybe, if everything goes perfectly smooth, Daryl, that we have a point in time balancing. The most interesting part about this graphic, in my estimation, is the primary mine supply, the darker blue at the bottom of those vertical bars. You can see the primary mine supply, they have peaking in 2029. Well, what is that? That is largely the ability of Kazatomprom to increase their production, right? So if you look at Kazatomprom's graphic, and maybe I'll move away from this and I can actually share that, because I think that's really, really interesting. I'll pull that back. I'll pull that up in the background here. Kazatomprom is showing that they intend to increase their production in the coming years. And that looks like primarily a boosting of production at one or two large projects, and primarily one project. That's the Budenovskoye 6 and 7 project. This is a joint venture with Russia, and this is going to go from almost no production last year to 6,000 tons, more than 15 million pounds a year of production in the next few years. And they probably are going to be able to do that. In the graphic I just showed you from Canaccord, our own modeling, we are assuming that Budenovskoye is going to achieve subsoil use, which is 6,000 tons a year. If you give me a second, I can pull this up, Daryl, because I think this is really important. Okay, so this first graphic is, and this is according to their proposed changes, which is basically saying what they're planning on doing. So these changes include adjustments to the subsoil use contracts for a few of their projects. One or two of them are being adjusted down, one or two of them are being adjusted up. So you can see what they're shooting for essentially is production peaking in 2027 at like 32,000 tons. That's about 82 million pounds of uranium per year. They won't get there, at least not on that time frame. But Budenovskoye is going to get the priority of available sulfuric acid, not only from their own sources, which they are building a new sulfuric acid plant. It is under construction right now. It's been under construction for the past 18 months or so. They believe that that plant will be online in 2027. The Russians are also building a sulfuric acid plant in Kazakhstan. Same capacity, 800,000 tons a year. Half of that will have commitments to agriculture. The other half will go to Kazatomprom, which means into the ground on our project. So Budenovskoye, big mine, right? 6,000 tons a year, 15 million pounds a year. Even if they achieve that, which they're more likely to achieve that for Budenovskoye, whether or not they achieve subsoil for the bulk of the remainder of their projects remains to be seen. Look how unbelievably steep that decline curve is. It drops off a cliff in 2031. I mean, it goes down at a 45-degree angle. And this is based on the existing projects that are currently producing, the lifespan of those projects. And of course, Budenovskoye is brand new, so that has a long life to it. It's very large. But if you look at this other graphic from Kazatomprom, from the same handout, the most recent investor handout, it shows you even if they invest in new geologic exploration and the development of new projects in later part of this decade into the 2030s, you can see that the decline curve is absolutely persistent, even with the possibility of expected new geologic exploration to, let's say, bolster the decline of their existing projects. Now, this is just Kazatomprom. You have to also take into account the other
That's
existing
very
producing
bullish.
mines. Yeah, it's crazy. So many producing
That's
mines
very
right now
bullish.
face incredibly steep decline curves in the next decade. You're talking about Langer Heinrich towards the end of the 2030s. Cigar Lake is done mid-2030s. Husab is in decline in the 2030s, which is a gigantic Chinese mine in Namibia. Rossing is done. 4 Mile is done. MacArthur sees decline in eventual, late 2030s, maybe early 2040s. We have a very, very concerning supply situation in the 2030s, and we've got to see investment and development absolutely now. We needed it yesterday. We should have seen $100 term prices 2 years ago to incentivize this stuff. You're going to see fluctuations near term based on the dynamics in the physical market and the equities markets. That's going to go up and down as it does, but the general trend is going to be up. This is by no means over.
Wow. Yeah, that's pretty. It's very bullish, but it's also very concerning. Concerning seeing that. I mean, because Kazatomprom makes up how much of the uh, current supply? I mean, right?
It's
You,
about
you said,
40% of global supply right now on a 100% basis.
wow.
Yeah.
Yeah, that's yeah. So where does it come from? Like, so do we need
I mean,
permits and
ultimately, I believe in, the free market, and that the free market is going to find the solution to the problem. We need higher prices, but it needs to happen, and it needs to happen soon. So utilities are going to have to continue to contract at higher prices, at these prices and higher, in order to incentivize all of these marginal projects. Like the low grade stuff in Namibia has got to get built. We need to see Etango and we need to see Tumas built. We need to see some of the other low grade stuff in Australia and the United States built. We need some more large projects in Saskatchewan. Like all of this has to happen because the demand picture is so robust. And even based on the models of what is already under construction and is likely to be built, there's a situation and it's going to have to be fixed. It gets fixed with higher prices, but we can't really grind out much longer at these prices before we start to see projects being delayed, projects not getting built. We'll have to see how that goes, but higher prices are needed to balance the market, period.
Yeah, because I know there's a lot of. I mean, I'm invested in a couple of junior exploration companies, and they need the funding to build that out and
Yep.
stuff. And so they got the land, but you have to have the big capital come in to develop the projects and everything. And so yeah, well, shoot, that's very bullish, and that's a good note to end on. So thank you, Justin, for bringing your knowledge and expertise. I mean, that was like a subscriber, Uranium Insider subscriber type type webinar we just did there.
Yeah, it's my pleasure. I mean, these things are enormously complex, but like I said, the demand picture is relatively easy to model. So it's strange to see such a different number from an entity contrasted against every other model that I've seen, really. But yeah, it's my pleasure, Daryl. You got to have a grip on what the overall long-term outlook looks like, because that is necessary in order to have conviction when sentiment is as bad as it's been the past few weeks. Because if you don't have high confidence in where this is going to go ultimately, you're not going to want to buy when the market gives you these opportunities.
Yeah, that's true. That's true. Well, appreciate you for coming on. You all be sure to check out uraniuminsider.com. I will link to it in the description below. Thank you for your time, Justin, and we'll be in touch.
My pleasure. Always good to see you, Daryl.